Good afternoon. I'm Tami, Fratis, Managing Director at ACT Capital Advisors, and I'm your host for today's show on Money Matters TV. Welcome to the show. We have an exciting show today. My co-host is Doug Bloom from DAB Ventures. Hi, Doug.
Hi, Tami. How you doing?
Good. Welcome to the show.
Thank you.
So, Doug, you have an interesting background. Why don't you talk a little bit about how CEOs can create more leverage without burning out or losing control? But before you answer the question, just talk a little bit about your company.
Okay, so I'm a former venture capitalist, former venture-backed CEO, former entrepreneur, who started crazily coaching and advising businesses some years ago. And what we do with businesses is we help them get clarity on their vision, and then clarity on the roles, responsibilities, accountability, cadence, and through that we create growth. With respect to your question, what we do with CEOs is we help them understand what they need to let go of, and what they need to hold on to, and that creates space for them, head space and activity space for them to be much more creative, much more strategic.
And what tells you that whether or not a company is ready to take outside capital into fund growth?
Well, you'll hear it all the time from me. It's the same answer probably to every question. It's about creating a culture of accountability and cadence, and a focus on long-term goals which are meaningful. So focusing on the 20% of activities that generate 80% of the results. So if that company can articulate a plan, execute a plan, and show you how they're going to use capital wisely and create value, then it's ready for capital. If not, if they're just going to scale the chaos, then they're just going to throw money out on a fire. So
to that point, at your firm, you use something similar to the EOS system called Pinnacle to help build accountability. Is that correct?
Correct. I'm a Pinnacle business guy. There's about 120 of us nationwide, mostly former guides and former CEOs. I happen to fall into the latter category. And what we do is we have a set of processes, not a fixed set of processes. We adjust it depending upon where the company's at. But we walk through everyone on a quarterly basis, and for me, my clients, many of them are bi-weekly, developing a cadence, accountability, and setting goals and realizing goals.
Right. And so what factors do you think most correlate with entrepreneurial success?
I think market pull. If you're not being pulled into the market by your clients, then you're going to have to create your market. You're in a losing battle. Accountability, strategy, and one that probably is akin to your heart, financial acumen. If you can't speak the language of business, which is accounting, then you're not going to be invited to the table for the talk.
Okay, great. Well, thank you so much for answering those questions for our audience. I know that you had some questions you wanted to ask me, so now's as good a time as ever.
So with ACT Capital Advisors, what's the primary mission of ACT Capital Advisors?
Well, it's ACT. We spell out the acronyms because they are based on our founders' last names, with the A being we wanted to be first in the yellow pages, which some of our audience might remember the yellow pages. That's something that we don't have anymore. But
I'm too young.
Yeah. Well, I'm not. So I know about those yellow pages. So it was C and T, and then the A went in. And the question was, what do we focus on to get our clients ready to sell? Well, we certainly want them to strengthen their financial performance and documentation, just like you mentioned. GAAP financials, audited financials. They need to build a strong independent management team below the CEO, because the VCs always say, what happens if this owner or the CEO gets hit by a bus? Who's going to drive the bus? So we have to have a strong team. We have to streamline operations, so operational efficiency, and document processes, sales, HR, compliance. And we have to diversify the revenue stream so there's not revenue concentration. And also we like recurring revenue. And we have to differentiate the business. So to your point, the people want to buy the product or service, not we need to sell. We have to figure out a way to get people to want what we're offering. And then on the sell side, you have to prepare for buyer due diligence. And for also on the sell side, you have to plan for tax efficiency. With an M&A advisor, obviously explore all options for selling and also the best time to sell. So first and foremost, get professional advice, including coaches.
That's awesome. I apologize on the ACT. The one of the things that people selling a business run into is there's two pieces. They don't plan it. They really don't have a long-term plan well before they get into thinking about actually selling their business.
Right.
And two, they really don't know where their market's going to be for their business. So they go at it maybe locally when they should be national when they should be locally, selling to a strategic buyer when they think they should be selling to an economic buyer. How do you help companies sort through all that?
Sure. Well, there's some firms that provide complementary services to business owners like BDO, Raymond James, ACT. So we can help the firms both look at what kind of financial plan do they need to minimize taxes on the sale of the company, what kind of accounting do they really need to fill in gaps for? And on our side, ACT, we will provide a free valuation of the business so they at least know whether with their financial planner it's going to be enough to live on after they sell the business.
Cool.
So when people are selling businesses, you mentioned local or regional or national. It's really important to go with national advisors on the M&A side of things because they have the most depth and breadth to find the best strategic or private equity buyer. It's good to go on a local or regional basis if your best strategic buyer happens to be in your region. So it's important for the owner to know who their best exit is, and somebody like yourselves, Doug, could help them figure out what is their best exit strategy. And then you could help them to the best advisors.
One of the things to run into with business owners is they're not really prepared to sell. And you should always be preparing your business for sale because that process of cleaning up your business, getting things organized, and creating some space for the CEO to be transferable, so to speak, creates a better business life for not only the CEO, but all the people that work in the business.
Right. So we're going to take a question now, Doug, from the audience. We have Janet Martin from Philadelphia wrote in, what is a no penalty CD and what is the minimum deposit? I thought Janet had a different question, but we can answer that. A no penalty CD is a way to have more liquidity when you invest in a CD. So you don't have a penalty if you withdraw it before the term is up. You don't get quite as high of a interest rate on the no penalty CD as on a regular CD, but you do get a higher interest rate than in a savings account. And typically you can open a no penalty CD with as low as $250. With some of the community banks, it's $500, or credit unions, it's $500, and with some of the bigger banks, it's $1,000. So if you have a question, here's how you send in your question to Money Matters.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, dash matters, MATTERS, TV.com.
So now we have an exciting guest on the show. Leo Chubinishvili, a CFP, is going to join us and tell us all about Access Wealth and how we make sure we keep our wealth for as long as possible. Welcome to the show, Leo.
Thank you, Tami. I appreciate it. Happy to be here.
I'm glad you're here, and hopefully I didn't destroy your last name too much.
Just a little bit.
Just a little. I'm so sorry. So anyway, so tell us
okay.
about what kinds of unpredictable situations you help your clients deal with when they're considering retirement or if they've already retired.
Right. So uncertain situations, happen all the time, unfortunately. I think retirees deal with, personal level uncertainties, which can be healthcare issues, can be death in the family, could be family, financial support for your loved ones. And also on a global level, something like we're dealing with right now in April, where, global trade wars has caused market volatility, or inflation spikes in 2022. The pandemic in 2020, recessions, stock market crashes, all those things can affect your financial stability.
Wonderful. Thank you so much for that. Now, how exactly do you stress test what your clients need to do to prepare for retirement?
Right. So best defense against best defense against the uncertainties is to have a financial plan. And ultimately what we do is we stress test the scenarios. In other words, we create alternative scenarios, what if scenarios, and just to see how the portfolios and your financial plan holds up during these events. For example, what if there was a recession and the market lost 20%? What would happen to your financial well-being?
Mm-hmm.
We run a different, essentially different scenarios, but use different tools to stress test them. One of the ways to stress test them, as an example, is a Monte Carlo analysis, which is strictly a power of technology, takes your financial picture with the projections, does 1,000 different simulations with different market returns, and comes up with a success rate, the percentage, the amount of times that you did not run out of money if that event was to happen.
So Leo, you're talking about retirement, and retirement typically features passive income paying for expenses. And that's the game plan. How do you guys determine what the passive income needs are that are going to cover expenses for your clients?
So very, very individualized, that there is no one size fits all. I think it's certainly dependent on someone's lifestyle. You're right. It's mainly fixed income, although we do see a lot of retirees having different retirement assets, whether it's pre-tax buckets of money, such as traditional IRA, 401k. They could have, Roth funds as well, which are tax-free. So based on the lifestyle, based on clients' goals, objectives, and really the risk tolerance decides how you should kind of develop these withdrawal strategies to make sure that clients do not run out of money. And then ultimately you want to update these plans on an annual basis and stress test them with alternative scenarios.
So what kind
Go ahead.
Sorry, Doug, go ahead.
So when should somebody start talking with you?
I think everyone should start doing financial plans as early as they could. We do see a lot of people come, in their 40s, 50s, leading up to the retirement. And so that's when the time kicks in where you really need to get serious about your retirement. There are great strategies that you could utilize leading up to your retirement. Whether it being more aggressive into the portfolio or dialing down the risk. Roth conversions are a good way to kind of save future tax dollars. So I think anyone is welcome, obviously, to come to us. We're more than happy to help. But probably, in the 50s, I would say is the most important time to get serious.
It's really good to know. What are some of the typical mistakes, other than waiting too long to plan, that your clients make?
I think the big one is really just making, emotional decisions. I think when things get uncertain, it's people get nervous, then emotional decisions kick in, and a lot of times those are mistakes. I think a lot of people also don't think about the events that may happen, or they don't think it would happen to them. So a lot of times it's just holding hands and essentially walking them through the highs and lows of unpredictable events. Additionally, for people that retire, I think the transition from a saver to a spender is not easy. I think a lot of people struggle with that. Also, some people spend too much early. They don't think about the healthcare costs, such as, let's say, long-term care that may come into play in the later stages of their life. So certainly there's a lot to think about and kind of plan for.
So do you find that a lot of your clients underestimate what they actually spend?
Yes, I think most people underestimate what they spend. It's very individualized, as I mentioned. It's dependent on the money habits of individuals. It's dependent on the relationship that they have with spending. Some people don't care at all what they spend, when they spend. Some people are very frugal. As a professional, my job is to fit the financial plan based on their characteristics of their spendings or their income, etc. So go ahead.
No, thank you for answering that.
The current media climate is and economic climate to some degree is perceiving that we might be running into a longer term recession. Does that change the mentality of the questions that come in? I mean, do you have to talk people off the ledge, or do you? I mean, because somebody who's got their retirement pretty well squared away, probably is going to be indifferent to economic realities if they have done a good job. What's your view?
Right. So I've gotten a lot of calls in April up until now. I think people are worried when there is so much uncertainty about what may happen. The conversations are similar most of the time, where I remind them that the financial plan that we built is resilient to these issues. And ultimately the short-term volatility shouldn't derail the success of your long-term plan. And that's really what it comes down to. Most of the time, people are prepared, at least our clients. I mean, we've ran these alternate scenarios. We know what could happen. Some people, we may increase the cash that we're holding so they can have enough for a couple of years while the market is down. But at the end of the day, our objective is to make sure that retirees have enough money to last them through their life expectancy.
So what does a comfortable retirement look like?
Well, I think comfortable retirement is an ability to have options and choices, and kind of being able to do what you want when you want, without having to stress about financial security, being able to spend time with your family, being able to travel, have hobbies. But all of this should be done with the peace of mind that your finances are okay. Whatever that may come up, whatever uncertainties that may come up, you will be okay. And end of the day, our goals are to enjoy life. And if you're not financially secure, or it brings you stress, then you're not quite happy.
So it sounds like you really dig down into the weeds to really figure out what a client needs to be able to have that comfortable retirement every year. So whether or not they take one big trip, or whether or not they have one kid getting married a particular year, they need to plan for all of that so that they can cover it and not have to sell, stocks when the market's just tanked 15%.
That's exactly right. Mainly that's kind of a short-term planning. Usually what you want to do is have cash reserves, an emergency cash. Really, I mean, it depends, what your financial picture looks like. But for retirees, it could be anything from 3 months to 24 months of your monthly expenses. That way you don't have to sell anything when there is a downturn. And also just to have quick access to cash if there is an issue. It may take a couple days to liquidate some of the assets or even longer. I also find that some people just like to have cash, that it brings them peace of mind, and numbers may show otherwise, but sometimes it's just worth keeping more cash on hand if it makes you sleep better.
Leo, a little bit of a different question. How'd you
Please.
get into helping people with their retirement planning and services? What was your origin story?
Yes, good question. I just enjoy really helping people. I've always been a people's person. I'm more of an extrovert than an introvert, so I really enjoy talking to people, digging deep, concentrate on details. And I always wanted to be involved in some type of business-oriented industry when I was young. I started my career in the financial industries, and since then I've never looked back. So I love every single day of it.
Wow, that's great. So I hate to bring up the subject of taxes, but how do you help your clients with their tax needs? And do retirees have different tax surprises than non-retirees?
Yes, so the tax planning is a big part of the overall comprehensive financial plan. I think a lot of people, retirees think that when they retire, they're retiring from taxes, but that's really not the case. Taxes do not go away. They could be minimized, but not fully eliminated. There are various strategies, just to name few. For example, distribution strategies from your pre-tax accounts or Roth accounts or your brokerage accounts, making sure that you do not go into the next bracket. As you may know, tax brackets are gradual. So more money, more income you have, more taxes you pay, and then eventually you could get bumped up to a different tax bracket. Roth conversions are a great tool to minimize some of the tax liabilities in the retirement years, because now you have tax-free bucket of money that you could use whenever you want. Tax loss harvesting is a good strategy that we do every single year to offset some of the capital gains and dividends, and even give clients an ability to deduct some of those losses if possible.
So do you find that the media influences your clients? So what I'm thinking of when we were talking about cash on hand, 3 months versus 24 months, when you see in the media that some banks aren't letting their clients withdraw their money from the bank, does that make your clients call you and say, I need more cash, or does it not really impact you as much?
To be frank, I haven't had that issue as of yet, but I think to answer your question about media, yes, I think media really affects everyone. I think people hear certain things on media, what may happen or what happened or what could happen, and obviously brings anxiety and stress. And usually I'm their first call. And so the conversations are essentially to calm them down, remind them of the plans that we've gone through, and remind them that we've built a resilient financial plan, and whatever the event that may be out there, we'll be able to handle it. Most portfolios, by the way, Tami, do have a degree of cash, so they have access to cash if they wanted to.
So what questions haven't we asked you that if you were answering it, your potential clients would say, I need to call a financial planner as soon as possible?
Well, I think everyone really should have a financial advisor. I think, we, for example, specialize specifically in a custom tailored advice as far as the planning goes and investments themselves. As I mentioned before, it's not one size fits all. Everyone needs more or less a customized advice. And I think that's where the power of our really industry comes in, where you're able to customize a specific issue and give them essentially the advice that they need, that it fits their financial picture and financial well-being. And then after that, it's just being in touch, updating plans, touching base about investments, keeping them updated about the important information, and just be there for them. And that's what we do at Access Wealth, and we're proud of it.
And do you focus in any particular geography, or are you national, or are you regional? Where do you get your clients from?
So our office is located in New Jersey. We have clients all over the country. And ultimately, we're happy to help with everyone. I personally have at least, I want to say maybe 12 to 15 states where I have clients. So we are, nationwide.
Right.
So Leo, just out of curiosity, the old rule was 60-40, 60% stocks, 40% bonds. And I've read recently it's 50-30-20, 50% stocks, 30% bonds, 20% alternative investments, whether that be real estate, gold, metals, Bitcoin, private equity, venture capital. What do you guys, I know you guys are customizing. What are you using as a guideline?
So good question. We actually use 10% as an alternative for, if you took 60-40 portfolio, 10% of it would be alternative. I think the alternatives have come a long way over the years. I think it's an important part of portfolio. Again, should be customized to person's needs, but there is definitely a place for it. Because end of the day, if you can find assets that aren't correlated to equities, stocks or fixed income bonds, that should improve theoretically the risk return ratio on your accounts. So I'm a believer in alternatives. Yes.
Are you seeing that improvement in your modeling that you're doing, your Monte Carlo modeling?
Well, yes and no. Our portfolios, yes. So yes, in a sense where our return, in other words, I believe we're getting a better return for the least amount of risk. Now, Monte Carlo is actually taking an entire picture of a person or a household, and ultimately run different scenarios, market scenarios on that. So it's a little bit difficult on a Monte Carlo just because the standard deviation, meaning risk, is not exactly judged because there's a lot of variables such as taxes, different cash flow, expenses, inflation. But overall, yes, we believe in alternatives. But we also, we have an investment committee at our office. So as a committee, we decide what makes sense based on the economic indicators and the economic environment that we have. So it's not a strict rule of 10% alternatives, but that is our guideline.
Leo, we really appreciate you being on our show. And thank you so much for being here. Our next guest is going to be John Hyman of Rockwell Capital Funding, LLC. Thank you, Doug, for joining me as co-host. I really think we had a good show today. And thank you all to our audience for watching Money Matters TV. I'm your host, Tami Fratis. Have a great day, and thank you all.